Okay. All right. Please, can we see the screen?
Yes.
Okay, very good. Yes. So this is financial reporting syllabus. Um, yeah. So it's first and application level. So which means the exams is an application form of exams where you are given a case and you apply the concepts, the principles that you have learned to approach or to solve the question. All right. So let's look at the contents of the syllabus itself. Let me go down. Okay. So the syllabus or the exams is divided into four. One, two, three, four, five. We have five main components or five main questions. And the pass mark, everything is 100%. The pass mark is 50%. Which is quite easy to. I mean, not easy. It looks easy on the surface, but it's not easy like that. Okay, the pass mark is 50%, right? So, and this is the breakdown of the marks. So the first um area is 15 marks, which is the regulatory, legal, and ethical frameworks, the International Accounting Standard Board, conceptual framework, current issues. Okay, so this is more of, let me say, theory, but then they can give you a case and you have to analyze ethical case and you have to try and come up with the ethical issues and the current issues. All right, so that is 15 marks. 15 marks. Then we have application of accounting and financial reporting standards, okay, which is 25 marks. How to apply the standards, 25 marks. Now we have single entity financial statements. Single entity financial statement, which is 20 marks. Then we have business combinations, which is also 20 marks. Then we have analyzing and interpreting financial statements, which is 20 marks. So, we have 100 marks. All right. Yeah. So let's look at some of the easiest areas and the difficult areas. So, this one, analyzing and interpreting financial statements, it's fairly easy. The ratios, at least, as compared to the rest, you can if you can get 15 out of 20, it's cool. All right. Then business combination, that's the consolidation. Business consolidation can be challenging, so but then you also need to try if you can get maybe 10 out of 20, or if possible if you can get 15, it's fine. But if you're able to get 10, it's not bad. Then single entity financial statement, that's 20%. So this also can be challenging, so that one too, you need to put in a lot of effort. And it's also time, these two, they are challenging and also time consuming in exams. So if you are not careful, you can spend all your time on consolidation, and the same applies to the financial statements. Then application of accounting standards and financial reporting, 25 marks. This one is fairly easy. That if they will give you very simple cases, and I mean, not simple though, but at least straightforward, and I mean something that you can handle. 25%. And it's not time consuming as this and this. So if you master the standards, you can get 20 here, 20 out of 25. I mean, if you're able to master it, you can get some marks here. Then the regulatory framework and the conceptual framework and on the rest of this area, there's more of reading. So this one you can even get the maximum marks if you are able to, I mean, master it well. So this is how the syllabus is structured. So you can see the focus is on the standards because that carries the highest marks. So it means to pass or to fail also depends heavily on your understanding of the standards. Do you get it? So we need to focus on the standards, the accounting standards, to in order to pass. In order to pass. Yeah. So that is the breakdown of the syllabus. Right. That's the breakdown of the syllabus. So in this exam, in this class, we'll cover all this. We'll cover all these topics. We'll try and explain the concepts as much as possible for us to understand. And we'll do some exercises, practice so that we can also um, we can master the concepts. All right. So yeah. So having said that, yeah, let's get started with today's class. All right. So today is going to be an introductory class. So we are going to look at the foundation of financial reporting, and then we'll build the rest from there. All right. So let me share my slides so that we can see. We can all see. Okay. I hope we can see the screen, right? Can we see the screen? Hello.
Yes.
Okay, very good. Correct. Yeah, so today we are looking at international accounting standards and we also look at ECPIS. All right. International accounting standards and ECPIS. Okay, so let's go into it. Okay, so let's talk about financial reporting. Everything we are coming to do in this class is about it's about financial reporting. We are trying to prepare a financial report. So what is financial reporting? What is this about? And why do we even prepare financial reports? And who are the users of the financial reports? And what are the qualities of a good financial report? So that is um, something that we need to at least understand from the beginning. Yeah, so financial report is a branch of accounting. Accounting has several branches. So we have, if you take accounting, we have management accounting, we have what else? Taxation. They all fall under. We have audits. We have maybe we have financial reporting. We have maybe finance, a little of finance. Yes. So accounting is broad. We have various aspects. So we are looking at this. This paper is on financial reports. How do we prepare financial reports? A report. And what is a report? A report is just a statement of facts. Okay, it's of a statement of facts about an issue or about maybe an event or about an incident. Okay, a report is a statement concerning an event, an occurrence, an issue. Yes. So when we say financial reports, we are trying to prepare a statement that describes our financial status, our financial position, whether we are doing well or not, our financial performance, so that is financial reports. So, and this report is not prepared in vain, there's a reason for it. So the report helps us to know whether as a company we are meeting our targets, we are not meeting our targets, we are falling behind, there's something that is missing, or we are doing something well, we are not doing something well. So that report will give us that information, to help us to know what is going on in the organization. Without financial reports, we can't even track our growth, whether we are growing or not, whether we are performing well or not. And it can be very things can get messy. And you know other entities also rely on the financial reports. Other entities and other stakeholders, they also want to know what is happening in the company, like tax authorities. GRA want to know whether the company is making profit or not, so they can come and take their money. Shareholders, they have invested in the company. They want to get returns from their investment. So, is the company doing well? They want to know what is going on in the company. Yeah, investors too. Let's say invest potential investors. They want to know whether this is a profitable venture where if they where their money will be safe, or their investment will be safe. Where if they invest in this company, will it be safe for us? So investors and who else? Maybe creditors, banks, financial institutions. They also want to. I mean, look at your credit rating. Do you have a good credit records? Can you pay your loan? Do you have enough liquidity? So these financial institutions who are interested in your performance, and other regulatory bodies. So, registrar of companies, you have to file your annual returns. They want to see whether the company is doing well or not. And other regulators, every industry and then their regulators, like insurance, we have industry have their regulators. The banking industry, they have their regulator. So the regulators also want to know whether you are doing well or not. So, and customers, employees, even employees want to know whether the company they are working for is doing well. If not, they will have to advise themselves ahead of time before the roof falls on their head. They have to uh, they have to know what's going on in the business first before they decide what to do. So a lot of people are interested in the financial report. They get, and they will use it to make different kinds of decisions. So you can see that the report is very important, and the report is what very important. And we all know human beings are not angels. If we are angels, like I mean, we are blameless, we are holy, we don't lie, everything is we are perfect. In that case, um, whatever report comes out from from the company, we will accept it because we know that I mean we are holy, we are blameless, we are like angels. So we will trust the reports. But right now, human beings, we all know that we have trust issues, so we will not we don't take reports like because of how important the report is, we don't accept the reports as it is. Even after preparing the report, it's hard to go through audits. Auditors must come and look at it to make sure whatever the people have stated is correct, and all that. Yes. So to ensure credibility of the report, to build trust among stakeholders, or to enhance the confidence of users of financial statement in the report, we have the accounting standards. So the accounting standards, their guidelines help to ensure that the financial reports are prepared according to international standards, and whoever takes it, ali has some comfort that the report has been prepared based on international standards, so at least I can rely on it and make decisions from it. Okay, so that is why we have the accounting standards, because of how important the report is to various stakeholders. We want to en- ensure we want to make sure the reports can be trusted. We want to enhance the confidence of users in the financial statement, that the report is can be relied on. So that is why we have the accounting standards. All right. So when you take a typical financial report, it has three main components. Let me say yes, three main components. We have the statement of the income statement, or that is the revenue and your expenses. So the revenue for the year, your expenses for the year, your gains and losses, they all fall under income statement. Then we have your assets. We have your statement of financial position. Yeah, this talks about your assets, your liabilities, your equity. So at the end of the year, what how much assets are you holding? How much assets are you holding? And what was the name? What is your liability? How much are you owing others? How much are you owing others? Your equity. So the equity is how much is available for shareholders. So let's say that at the end of the year, our asset is maybe 10,000. So this is our assets. Then we are owing some people. We are owing creditors. Maybe we are owing maybe 8,000. I see. So it means what is left? It left with 2,000. So it means that if we say we are paying all our liability, if we are to settle our liability, this is what will be left for shareholders. Uh, So it means shareholders only have 2,000 CDs in the business. Okay, so as a shareholder, when you see the report, okay, you look at it, and based on that, you decide whether the company is doing well or not. So that is how the financial report is. We have the note, the income statement, the statement of financial position, and we have the notes and disclosures. So the note is adds more explanation to whatever is in the income statement and the financial position. Okay, so if you want to understand some of the things in the report, they will be found in the notes. Okay, they will be found in the notes. So you can read and the notes for further understanding. All right. So like I said, accounting standards are there to ensure or to enhance the confidence of users in the financial statement. Okay, and they are principles. Okay, they are principles and regulations and rules. Okay, so the standards will teach you how to prepare the report. Okay, so if you want to put together financial report, how should the presentation look like? How should we present the report? There's a standard for presentation of the report, and we call it IAS 1, International Accounting Standards 1. Even how the report should look like, there's a standard for it. And now they are even bringing a new standard, IFRS 8, 18, and so they are even
Sir,
changing.
somebody is trying to join. I think the person is facing challenge. So if you can check for us.
Oh, okay, let me see. I'm coming. Oh, 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 oh. Okay, all right. I think he will join. Okay, so let's continue. Okay, where was I? Yes. So yeah, so accounting standards are principles and regulations that we use to prepare financial ac- financial reports. Okay, and if there's a standard for a lot of items in the in the financial report, even the how to present the reports, there's a standard for it. It's called IAS 1. Okay, but very soon, um, it will be replaced by IFRS 18. There's a new standard called IFRS 18. It will start. It will be effective 2027. So now we have IAS 1. Okay, how International Accounting Standard 1. Okay, so how to prepare the accounting, how to prepare the financial report. Okay, so let's look at qualitative characteristics of useful financial information. Qualitative characteristics. Qualitative characteristics. So, like I said earlier, the report is very important to users and it must contain correct information, useful, accurate information. If it contains misleading information, all those who use the report to make decisions, they also go astray. Because if the report is wrong, and then whatever decision you make on the report will also be wrong. So yes, you have to make sure the report is correct so you can give an accurate um so um let's give an example. Maybe a company has reported revenue of maybe 1 million Ghana cedis. Okay, that's a reported revenue. Okay, now this revenue, this is what happened. At the getting to the end of the year, maybe they had sold probably 500,000. They have made revenue of 500,000 already. Okay, by 25th of December, they had sold 500,000. But maybe this is their target. They want to earn revenue of 1 million at the end of the year. So what they did is that they went to talk to their customers that, oh, we want to sell 500,000, 500,000 of our goods to you. Okay, on credit. Okay, we want to sell it to you. Yeah, on credit. So you accept it. And then I mean at the end of the year, the following year, if you can't, you can return it. Okay. If you think you cannot pay, you can bring it back. So making the company report revenue of 1 million. Meanwhile, I mean this is the legitimate revenue. But this 500,000 is I don't know. I don't know how to call it. It's not a proper revenue. Okay. Uh, who is this? Yeah. So this 500,000 is not it's not proper revenue that has been earned. So you as a user, you see, oh, the company has made revenue of 1 million. Oh, they have done well. Wow. Let's pay them bonus. You have paid them bonus to the employees. They have done well. The marketing department, the sales, you've all received the bonus. You see, they've received the bonus. Oh, And why were they giving the bonus? Because management or shareholders saw that okay, they have met the target, so they deserve the bonus. Now you can see that they are making wrong decision by paying the bonus, because this is not correct, because this sale is not genuine sale. It's just an arrangement between them and the customers to just push this sales to them, and so that they can, I mean, make their account look nice, you know. And they have taken the money, they have taken bonus. Meanwhile, it's not correct. You see. So if the information in the account is not correct, users will make some very drastic decisions, which eventually it can collapse the business. Do you get it? Yeah. So the the standards are there to check all these things. So there's even a standard on how to recognize revenue. So this revenue like this 500,000, if we are using the standards, this will not be recognized as revenue. Because this standard says only recognize revenue when you have performed your obligation in the contract. Like you have actually earned the revenue. If you have not earned the revenue, or you have not worked for it, you've not worked for it, you cannot say that it is revenue. Do you get it? So if a customer makes a deposit, is buying from you, they have made a deposit, you cannot say you have earned revenue, because you have not given the customer the product or the service. You see, so if you are going by the standards, it guides you as to how to recognize the various items in the financial statements. Do you get it? And it's also to protect the users, so that they make wrong decisions. Because as for the users, they are not in the company to see, I mean, what is going on and how the account was prepared. They All they see is a report as to how they prepared it. They don't know. So um, the standards are there to at least ensure that there's some decency in the reports. Okay, so yes, so that is it. So the standards are there to make sure we are reporting the right information. Okay, so when we say a financial information is useful, okay, the word useful, what is useful? Okay, useful is means, like i- useful means something that is helpful, like it's something that helps you to achieve whatever you want to achieve. Okay, something that is needed, that is that makes an impact, in whatever you want to do. Okay, so for a financial information to be useful, okay, it has to have two qualities. Okay, these are relevance, and faithful, faithful representation. Okay, relevance and faithful representation. Okay, so let's say relevant. So relevant. What is the meaning of relevance? Let's say relevant information. Okay, this is a relevant. When you say this is a relevant information, how what does it mean? So relevant means the piece of information is integral in whatever you are doing. Yeah, you want to make a decision. Okay, a relevant information is an integral information. It's like the foundation of whatever decision you want to make. So maybe let's say a young man wants to marry a beautiful lady. So he needs to get some relevant information. Maybe employ whether the lady is employed, maybe her educational background. Sure, beauty is part. I mean the physical features. Maybe the young man wants to. For the young man, that's a relevant information. Maybe how the lady appearance is a relevant information to him. And maybe the family where the lady is coming from is also relevant. When it comes to the ladies, when they are choosing a man, they have some very relevant information. They want to someone who has a car, who is established. I mean, someone who can take care of them. These are the things they look out for. Someone who has money. They don't want any poor man in their lives. So they need to get those information to decide that, oh, as for this man, the right person for me. You know. So a relevant information is an information that is helpful in decision making. You need it to conclude on your decision. Okay. So a financial report should have relevant information. So for instance, you are a bank, you want to give a loan to um, a company has approached you for a loan. They have given you their financial statement. So what relevant information will you look at? Anyone to help us as a bank? You want before you give an information, before you can give a loan, what relevant information will you need? Yeah, to decide that, okay, based on this, we will give the loan to the person. Okay, anyone to try?
So an information that is material.
Okay.
Should I explain that one?
Yes, yes. If you can, true. Yes, explain.
Okay, so for example, if a bank wants to give you loan, they will first have to check your financial statement. They
Okay,
do check the financial statement as to whether or not you can qualify, or normally they check your revenue, then your profitability.
okay,
So give them a material information about you before they can go ahead and grant you those loans.
okay, okay. Good, good. Yeah. So they check your revenue, and other material information before they can give you the loan. They also check your liquidity to check whether you have good cash flow. You have consistent cash flow, regular cash flow, where you can pay the interest and the principal. And they will check whether you have collateral to back the loan. In case you are not able to pay, what can they use to get back their money? Yeah. So these are some of the things they will look out for. So every stakeholder and what they are interested in. So if we take GRA, as for GRA, they are interested in the profits. As for them, they don't care about your liquidity, whether you have you 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 your liquidity is high or low. They look at the revenue, the profits you have made. and you have to pay. You have they will determine the tax on it. Investors investors too, they look at your, yeah, they look at your profits, they look at your efficiency. Like, how well do you use your resources? Are you efficient? Is there wastage in the system, or you are you run efficiently, and what is your return on investment? So if I invest one cd in it, in your business, how much will I get out of it? So they also have their certain relevant information they will look out for. So every stakeholder and the relevant information they need. So the information for you to have a useful financial report, we need relevant information and faithful representation. I mean, whatever you have stated in it, we should be able to vouch it, or we should it should be true. Whatever is there must be true. We shouldn't lie in the reports. Okay, so that is faithful representation. So that these are the two um, characteristics of a useful financial information: relevant, and what this one talks about. This is talked about truth. We don't want any lies in the reports. What whatever is there is correct. If you say your cash, your bank balance is 1 million cedis, when we go into your bank account, we should see 1 million cedis there. Whatever you have stated, we should be able to vouch it. We should be able to vouch it. Yeah. So that is it for relevant and faithful representation. Okay. Now we also have enhancing characteristics. So we have the key qualitative characteristics, which is the relevant. Then we also have enhancing. Let me say features. Okay. So these are not the main. I mean, these are add-on features to make the financial information more understandable, and more easy to read. So, what are the enhancing features? One of them is comparability. We should be able. So that's why financial statements, when you take them, you will see like the prior year, the current year, and the prior year comparable. So you can see the trend. So it is helpful. You know, so comparability, verifiability. So verifiability. Whatever you have, we should be able to verify it. And uh, timeliness, timeliness, and understandability. So comparability, we should be able to compare the result from prior years to see the trend, whether we are going up or going down. Okay, then we have verifiability. Whatever is in the report, we should be able to verify is. And timeliness, the report should be, I mean, should be on time. We don't. It should be current. We want reports that address current issues, that we need to make current decisions. So we are in 2025. If you are now preparing 2020 reports, I mean, how would that help? How would that help the business, or how would that help an investor? Yeah, maybe for GRA and Co, they need it to determine the taxes you were owing in the past. Yeah, but in most cases, an old report is not useful because it doesn't address the current issues. Yeah, so we need the report on time. Then understandability. So the report must be prepared clearly. I mean, make sure presentation is clear. You group all assets, all liabilities, all equity, all income, expenses. You shouldn't mix them. Maybe under income, you have mixed income and expenses. Everything is mixed up. Even though it will give you the same results because addition and subtraction, I mean, whether you mix it or whatever you do, you will still get the same results. But how you do it, how you present it can create confusion if you combine expenses with income and combine liabilities with assets. It can create a lot. I mean, it will be difficult to read the report. So you have to group all income aside, all expenses, all revenue, all assets, all liabilities. Make sure they are they are well classified. Yes. So in audits, in audits, most some of the adjustment we do is classification. Wrong classification. We usually check those things. Make sure you are classifying items correctly. All right. Yeah. So these are the enhancing features of financial reports. Okay. Okay. So when we look at faithful representation, so as for faithful representation, we mean that the report should not contain lies. Eh, so what are the errors that we were trying to avoid? One, we want to make sure the report is complete. Complete. So a faithful representation means the report is complete. So let's say all your expenses, you have recorded all your expenses. It's not like you have left some expenses out. You know, when it comes to tax, that's where the issue is. Usually people try to uh, leave out certain expenses like donation and maybe penalties. I mean, those expenses that GRA will not accept, you know, people try to remove them in the accounts so that GRA will not see those expenses. But they say for faithful representation, everything must be complete. Then neutral. Neutral means no bias. Whatever is there should be neutral. Nobody should have a personal interest in the account. Like the whoever is preparing it should not have an interest in it to maybe twist some figures or inflate some figures and that and all that. And also it should be free from error. We don't want to see errors in the statements. We don't want to see errors. Okay, so that is faithful representation. Okay, so if we say a financial statement faithfully represents the company, the performance of the company, we mean that the statement is complete, is neutral, is free from error. It's free from error. Okay, let's continue. So let's look at some of the financial reporting scandals. Yeah, there's this popular scandal in the US and the Aaron Corporation. Aaron, this is a very popular financial reporting scandal. So there was once a very big company. It was an energy company. They were into energy commodities. Very very huge company. It was called Enron in the US, and they were involved in financial reporting scandals. And the matter came out, and it had devastating consequences. The company collapsed. Some of the CEOs were imprisoned and all that. Some of them died, and so on. But what happened? What did they do wrong? Yeah, so they were inflating their the company's earnings. So they were always trying to look good before the investors, trying to inflate their profit, their revenue. So investors be will be happy that, oh, the company is doing well. Okay. And they were also hiding bad debts. They were hiding bad debts because they were entering into um, risky transactions and deals. When you enter into risky business deals, you can lose your money because they were aggressive, very aggressive, trying to appear good in front of investors. They were doing whatever possible to always look good, always entering into scandalous deals and whatnot. And they were caught. And when the scandal led to loss of billions of dollars, billions. So shareholders lost over $74 billion because of the scandal. See, so they were all they were doing was they were hiding the company's bad debts. So they will not see the company has some bad debts. And also the auditor. So they had an auditor called Arthur Anderson. Arthur Anderson was this auditing firm used to be a very one of the top auditing firms in US, and they also were influenced by the CEOs. They pressured them not to report those findings. So now Anders this audit firm collapsed. They took their license. The business also collapsed. Now so it's from that point that um, um international organizations and other international bodies came up with this. What was the name? This corporate governance. What was the name? Corporate governance. What was the corporate governance structures? In place. So even in Ghana, we have there's a corporate governance. What's the name? Document that companies must follow. If we are registered under SEC, Securities and Exchange Commission, there's a corporate governance. What's the name? Regulation you have to follow. All these are there to check this kind of fraud and yeah, fraudulent financial reporting. So financial reporting, if it's not done properly, it can have devastating consequences. That is why the standards are there to check all these things. Okay, there's also another case. Okay, also involving a company called WorldCom. Okay, they were also they were doing is they were inflating their assets. They inflated their assets by 11 billion. You know, and they were also capitalizing expenses. They were capitalizing their expenses instead of expensing them. So if you capitalize your expense, it will increase your profit. So it will look like you are making profits in the short term, but that's not the case. So that's what they were also doing. They were capitalizing their expenses and they were also inflating their assets. So for them, the scandal was discovered by their internal audit department, and the CEO was sentenced to 25 years in prison. Hey, it's not serious. 25 years, it's not easy. For fraud, conspiracy, and filing false documents. Okay, and the scandal also resulted over 30,000 job losses. So you see, a lot of people lost their jobs, and over 180 billion in losses by investors. So you can see the impacts, and it's all because of poor financial reporting. Because there were this does not meet the faithful representation criteria. So this issue is what faithful representation is not here. Okay, and that is what brought the downfall of the business. You see. Okay. All right. So let's continue. So let's look at IFAC Code of Ethics for professional accountants. IFAC Code of Ethics. So IFAC stands for International Federation of Accountants. Okay, International Federation of they are international body in charge of accounting. Okay. So they have a code of ethics for accountants. Every profession has their code of ethics. And accountancy is no different. We also have our ethical code of conduct. Yeah. So what is ethics? Ethics is I mean it's a standard of right or wrong. Okay. What we I mean the right thing to do. And that's when no one is watching you, the right thing you have to do. You know, the right thing you have to do to benefit society. You know, so the right thing you need to do to, I mean, to benefit society, to benefit the organization, anything that you do to not in a scandalous way. It's like okay, because I want to maybe help the company, I will cut corners. Not that, but anything that you do which is accepted by society that will help the organization to grow, to do well, that will also benefits society. Anything that you do that will benefit and not harm others. You know, yes. So that is um ethics. There was I read this case about an ethical uh, dilemma. It's about a man whose wife was sick, and the doctor prescribed a medicine to go and buy. And when the man went to buy the medicine, the pharmacist or whoever has the medicine quoted the price, and it was too expensive. It was too expensive, and the man couldn't afford it. The man begged the pharmacist, pleaded with her that, oh, I mean, he badly needs the medicine for her wife, this and that. The pharmacist did not accept it. He did not listen to the man. So in the night, when it was dark, the man, I mean, sneaked or broke into the pharmacy and stole the medicine and sent it to his wife. So now the question is, did the man do the right thing or not? Stealing the medicine to save his wife. Is it the right thing for the man? What the man did, is it right or wrong? This one I throwed it to the class. What are your views? Hello, am I online or I'm offline?
You are online.
Ah, okay, okay. So, what do you think in terms of ethics? What the man did, is it right or wrong? These are some of the issues.
Will you choose ethics over saving a life?
this it's not easy. It's these are very tough. I mean, issues. I mean, a life is at stake, and I mean, are you going to save, let the person die because, I mean, these are very, yeah. So the bottom line is, it's not easy as we see it. Sometimes it can be very challenging, when it comes to ethics. So, yeah. So these are some of the issues, some of the tough issues that, I mean, that is there we may encounter. So in the field of accounting, is because we are like the custodian of the company's finances. We are handling money and all that. So it means we should have high integrity, because the owners of the businesses, they trust. I mean, they have entrusted their finances into our care. So we must also behave ethically. You must also behave ethically. Yeah. So a professional accountant is supposed to act in the interest of the public, or in the interest of the organization, your organization. So you have to abide by the ethical code of conduct prescribed by the IFAC. Okay. So what are these code of conduct? There are five codes of conduct. So one is integrity, objectivity, objectivity, professional competence and due care, confidentiality, professional behavior, integrity. What is integrity? Integrity is the quality um of being of being honest, of being, let me say, blameless, of telling the truth, you know, standing firmly to what you believe, and not be moved by what others will say. Integrity. If it is A, you say it is A. If it's B, you say it is B. Yes. So a professional accountant should be straightforward and honest in all professional and business relationships. Yeah. So you have to be straightforward. You have to be very straightforward. Yeah. So these are the things. But when we come to the grounds, that is where the issue is. You know, objectivity. Yeah, you should be objective. You should not be influenced. You shouldn't be influenced. You shouldn't be biased. You should be objective in your judgments. Then we have professional competence and due care. Yeah, so you must be competent in the work you are doing. So you should have the right skill, yeah, right knowledge, experience for the work. And profession you should exercise due care. Due care means you must be tactful when you are w- I mean working on when you are dealing with accounts, or when anything you are handling, you must exercise some due care. You must always think twice of whatever you are doing, to make sure you are doing the right thing. Then we have confidentiality. Yes, as for confidentiality, it cannot be overemphasized. You must always make sure you keep things confidential unless you are allowed to uh, disclose. Then we have professional behavior. So, professional behavior means you have to carry yourself well in terms of your communication with others, in terms of your appearance, in terms of your manners, like you should have good manners, how you talk to people, how you relate with others. You should behave professionally, and not if you have anger issues, how to control your anger, you know, at the workplace. Yeah, so you have to behave professional as an accountant. Okay, so let's look at how accounting standards are set. Accounting standards, how are they set? How are they prepared? So accounting standards are prepared by international they are prepared by the International Accounting Standard Board, IASB. Okay, they prepare it. IASB is a board made up of 14 members, and they are all over the world. The members come from various um, continents of the world. Okay, and we have representation from each continent. Okay, so they form the board. They prepare the international accounting standards we have. Yeah. So how do they set the standards? Okay, how do they set the standard? So the board, they are always they have what's the name? They are always on the what lookout for any issues um in the accounting field. Any kind of, as things are always changing. So they are always on the lookout of any area that requires any new area or any special area that accountants are having problems with. They don't know how to deal with those certain transactions. Like, for instance, in this current era, we have cryptocurrency and virtual money and those things. So how do we report those kind of assets in our books? Is there any existing standard to regulate how to report these transactions? So they are always on the lookout for what is happening in the accounting field, in the business world, and try and develop a standard to address any new accounting hurdle. Okay, so every 5 years, the board conducts a comprehensive review and consultation to define international standard priority, okay, and develop a project work plan. And so every 5 years, they do consultation. They try and look into the accounting field, the business world, what is changing, what new is happening, and then they try and set a standard to address those issues. So let's look at the standard setting procedure. Okay, so first they do a research. Okay, they conduct a research and they explore areas where accounting problems exist. So they will go through, the complaints, the difficulties that accountants are facing, investors are facing, and a whole lot. And they will try and come up with a new standard. Like, for instance, this IFRS 18 that is coming, the International Presentation of Financial Statements. Okay, IS1. IS1 has been there for many years, and I'm sure they have seen some issues with it, and that is why um, they are trying to come up with a new standard to address those issues. So let's just go over briefly on what the possible issue might be. So under IS1, okay, fine, you have to prepare your income statement. You have to prepare your profit or loss, your balance sheet, and all that. But the income statement, there's no formula as to how to go about it. Okay, so usually we start with revenue, cost of sale. So usually we have what? Revenue, maybe cost of sale. The We have our gross profit. Then we have maybe admin expenses, employee, general and administrative expenses. Like all those will come here. Profit or loss on disposal of asset, investment income. Maybe if you have an investment income, you can add other. So that will be other income. You can bring it here and all that. Then you get profit before tax, a profit before interest and tax. So let's say this is profit before interest and tax. Then if there's any interest, you bring it here. Then we have profit before tax. Okay.
Uh, why have you included investment income as part of the expense?
Yeah, yeah. So like I was saying, IS1 does not have, I mean, it doesn't have a format when it comes to preparing the income statement. So companies are at liberty to, I mean, mix them. I mean, in terms of the arrangement, some of them can bring investment income here. They can bring, I mean, when it comes to the arrangements, there's no. So IS one, IFRS 18, is coming to solve this problem. How solve the problem of arrangement of the accounts of the items. Okay, so according to IFRS 18, we must group all the items into three categories. All these items here, we have to group them into three areas. Okay, so one area is what operating activities. Eh, So and yeah, operating activities, then investing activities, then financing activities. So when an investor takes the report,
But
okay,
how different would it be? Because this is the same way cash flow statement is done.
yes. So this is following the format of cash flow. You know, like how cash flow is arranged according to operating, investing, and financing. But it's different from cash flow, right? But they are just using the same idea. So all operating activities, all the income expenses of operating activities will show here. Ehen. So at the end of the day, you get profits from operating activities. Ehen. So when an investor takes the report, okay, they know okay from their operation, this is what they got. Then we come to investing. If they have an investment income, any investment expenses, then they also you will also put yes. So the investor will know that, okay, this is the investment income. Then financing activities. If there are any loans they paid, any interest on loan and all that, they also bring them here. Before we have our profit before tax. So IFRS 8 is just to arrange the items in the income statement. It's just like how cash flow is arranged. So we can see clearly the picture of the company's performance. But IS1 it is open, you know, there's no format. There's no format as to where you should put what. Everything it's all up to you. Mhm. So I'm sure the board saw the problems in this format, and now they have decided to bring this new standard to come and address this issue. You know, yeah. So that is how it is. So as and when they find an issue, they try and bring a standard to address it. All right. Okay. So yeah. So they'll do a research. And they, after doing the research, they will decide whether they need to set a standard to address whatever issue they face, they came up with. Then after that, if they decide they want to set a standard, then they will publish a discussion document. A discussion document. So it's like they will throw the issues to the accounting community, to the community, and gather ideas from various sources, gather all of them. Okay, so after the publication of discussion documents, they will collect all the comments from the community, the accounting community. After collecting the comments, they will do an exposure draft. They will do an exposure draft. Okay, they will, and the exposure draft too is also given out to the public for them to also look at it. Then they will collect the comments from the public, and they will use it to prepare the final standard. Okay, and the standard will be approved by the board. Okay, so it's from the research. They do a research, they come and do discussion documents, they come and do exposure drafts, and then they will set the standard. So this is how they set the accounting standards. Okay. Um. Okay. Purpose of. Okay. So here are examples of. There are lots of accounting standards. There are a number of them. So here are some of the accounting standards. So we have IS 1, presentation of financial statements. So this standard provides guidelines on how to prepare your financial statement. IS2, inventories. How do you report inventories in your account? So this standard is there to check that. We have IS36, intangible assets. How do we report intangible assets? IS40, investment property. How do you report investment property in your account? IS16, property, plant, and equipment. IFRS 9, financial instruments. So there are a lot of accounting standards, about 30 or so. Yeah, so there are many. So this is a statement of financial position, right? This is the format. So we have all our assets here. Is the classification. We are classifying our assets. All our non-current assets are here. All our current assets are here. All our liabilities are here. Even our liabilities, we have non-current liabilities, we have current liabilities. So as you can see, we have current liabilities, then we have equity. you know so when you take the standard, when you take when you go through the balance sheet, a number of the items have standards. Okay, so if you take this PPE, property, plant, and equipment, there's a standard for it. Investment property, there's a standard for it. Intangible asset, there's a standard for leases, the leasehold property, there's a standard. Financial assets, there's a standard. Inventories, there's a standard for it. Trade receivables, there's a standard. Cash and cash equivalent. So these fall under financial instruments like this and this. You know, what else? Stated capital. Is there a standard for stated capital? No, there's no standard. There's no standard for rate. Retained earnings. You know, retained earnings. There's no standard. Other reserves. Long term borrowing. Borrowing is okay. It's fall under IFRS 9. Financial instruments. Deferred tax. There's a standard for taxes. Long term provision. There's a standard for provisions. It's called IS. Is it 38 or so? There's a standard for provision.
37.
37. Yes, correct. Thank you. Yeah, there's a standard for it. Yes. When we come to current liabilities, we have trade and other payables. So this is um, it falls under financial instruments, short-term borrowings. This is income tax. This is provision. So, and a number of the items in the bank states in the balance sheets have standards. Okay, which we use when we are determining their carrying amount. When you are determining their carrying amount. Yeah. So it means we must cover all the standards for in order for us to prepare the balance sheet. Do you get it? Because as you can see, most of the items have standards we use to prepare them. So you need to understand what those standards are. Okay, what those standards are. Okay, so yeah, so that is it for um yeah, that is it for introduction to accounting standards. All right, so now we are going to start with the standards. Ali, we start with the easy ones first. The ones that are straightforward, easy to understand. We'll look at them before we look at other ones. So today we'll look at um, IAS 16. IAS 16 is property, plant, and equipment. Property, plant, and equipment. So this standard is for this. This standard is for this item. Okay, it falls under non-current assets. Okay, so what is property and what is plant and equipment? Okay, so property and plant and equipment, first of all, they are non-current assets, and also they are tangible items. When we say tangible, it means we can touch them, like we can feel them. Okay, they are tangible, they are non-current assets, and they are used in the production of income. Okay, we use it in the production of income. So, like factory machines, we use it to manufacture products. Um, Maybe delivery vehicle, we use it to deliver our product to customers. And computers. Okay, those ones are for administrative purposes. Okay, so we have they are used for production of income or administrative purposes. Do you get this? These are PPEs, property, plant, and equipment. Okay. So they are tangible assets that are held for use. Okay, so they are held for use. Okay. We use them for what? For production of goods or services, for rental to others, or for administrative purposes. So we can rent to others, we can rent to others, or we can use it for administrative purposes like office building. You know, office building does not generate income, but it is for administrative purpose. Okay, and they are expected to be used during more than one period. Yeah, so we expect to use those assets for more than a year. So that is why it is called non-current assets. Okay, because we want to just a moment. Okay, all right, let's continue. So we expect to use those assets for more than one accounting period. Yeah, so they are intangible, they are non-current assets. So let some of the issues we have to look at under PPE. Okay, so PPE, these are the issues we need to look at. We have to look at the initial measurements. Okay, so when you buy a PPE, how do we record it in the books? So we have initial measurements, then we have subsequent measurements. Okay, after initial measurements, how do we measure it in subsequent periods? Okay, initial measurements and subsequent measure. Then we have the measurement model. Okay, what type of model are we going to use? Okay, okay. Then we have terms like depreciation. Um, we have carrying amounts. Then we have revalued amounts. We have something we call revalued amount. Um, we have what we call revaluation surplus, or revaluation. So revaluation surplus or loss. Then we have disposal of PP. Like if you sell a PP, how do you account for it? So these are some of the key issues under PP. So let's look at the initial measurements. So we are going to use an example to help us understand. Okay, assuming that we are a business, so company XYZ. XYZ. Okay, they have bought a new factory machine. Okay, they are into manufacture of um let me say carbonated drinks. So they have bought some machines for their manufacture of drinks. So they are like, let's say, Coca-Cola. So they have brought some factory machines. Okay. Now they bought it outside. So let's say the cost. Let's say the cost, since it's outside, let's say they bought it in dollars. Maybe they bought it for $200,000. Okay. So this is the cost of the machine from the supplier. All right. Now they need a machine in Ghana here. Maybe this is from China. Okay. They bought the machine from China, but they need the machine here. So they have to pay for shipping and all that. So shipping, maybe shipping is maybe $10,000. Okay. Now the machine is at Temaport. They brought it to Temaport. Now the factory is at maybe Tema community, or maybe community 20, Tema industrial area. Or let's say the company is at Kaneshi industrial area. Okay, let me use Kaneshi. So it means they have to transport the machine to Kaneshi industrial area, North Kaneshi. So the transportation to, so here is in Ghana, we are in Ghana now. So maybe they paid um 20,000 for the haulage. Okay, now the machine is has come to the factory premises. Now they have to assemble the machine, because usually the machines are disassembled. So we have to make sure we assemble the machine. So when we assemble the machine, maybe it's 50,000. Now we have to test the machine to make sure the machine is working. So we have to test. When we tested the machine, the cost is maybe 5,000. Okay. Now we have to set up the machine, but we need to build a platform where we'll set the machine on. We have to build maybe a structure to put the machine on it. So we have to clear a place and build a structure for the machine. So that one too will cost maybe 15,000. Okay, now we have to pay duties. I think I have not added duties. By all means, when you get to port, you pay duties on it. So we pay duties of maybe 120,000. Okay. What else? Yeah. So let's say this is the cost. These are the costs incurred in bringing the machine to the to the site, to the factory. All right. So now, how do we determine the cost of the machine? What is the cost of the machine? So according to IAS 16, The cost of the machine is the purchase price, okay, which is the cost. Okay, so it's the purchase price plus all direct costs. Okay, any cost you incurred because of the machine. If not because of the machine, you wouldn't have incurred those costs. Okay, all costs you incurred because of the machine, we they are called direct costs. Ehen. So any cost you incurred because of the machine is a direct cost. It should be added to the cost of the machine. So it means the cost of the machine is going to be the the purchase price, which we have it here. And all these costs we incur them because of the machine. If not the
No
machine,
exchange rate.
yeah, yes, it's true. We have to incorporate the exchange rates. We have to change this into Ghana city. Yes, so we have to convert this dollars into. So let's say that the exchange rate right now is how much? Maybe 10.5 or so. Maybe $1 is equal to 10.5. Eh. So in that case,
At what point does initial training cost, for instance, I mean,
initial training cost. Okay. Yeah, so initial training cost. Okay,
for
so
instance, if it will be a one-time training cost.
okay, okay. Yeah, so if it's a one-time training course because of the machine, yeah, maybe we need operators. They don't know how to operate it, so it will be part of the probably the testing. We can include it in the tests, the course of testing and training. You know, as part of the cost of the. But here we have to be careful to ensure that it's a direct cost. If it's a direct cost, we can add it to the cost. If it's a direct cost, we can add it to the cost of the machine. Yeah, so we can include it provided it's a direct cost. If not because of the machine, we wouldn't be having that training. Then it qualifies as a direct cost. Okay. Okay. Are we good?
Okay, so just for clarity,
Why is the cost of training a direct cost?
Please, can you come again?
Why is the cost of training a direct cost?
Yeah. So like I was saying, when we say a direct cost, a cost that is incurred because of, the machine. Any cost because of the acquisition of the machine. Any cost like transportation, site preparation, and all that. But for training, it can be a little dicey. But if it's a direct, if the company can prove that it's a direct cost, it's because of it's because of the machine. That is why they are, because testing is part of the direct cost. So if testing is part, then training can fall under testing. As you are training, you are testing. So it can be put together from that angle. You know.
yeah, like I mentioned, especially if it is a one-time training cost, if it is going to be an annual thing or regular thing, then we cannot add it.
Yes, yes. If it's yeah a regular thing, yeah, in that case, yeah. But if it's part of testing and all that, as part of installation, we can include it as part as part of the cost. Because even in the training, we have to bring a professional to come and so that's professional fees. Professional fees is also part of direct cost. So we have to bring what's the name? Um, 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 a technician, to come and help with the setup and show the operators how to use the machine. Do you get it? So yeah, so they will fall. Yeah, so it will fall under testing and training. Yeah, but like I said, it should be direct. It should be as a result of the acquisition of the machine. Do you get it? Yes. All right. Are we good? Are we good to go? Yeah. So to get the cost, we get our purchase price, which is $200,000. We multiply it by our exchange rate, 10.5 cities. Okay, we'll put our figure here.
2.1 million.
Okay, we get 2.1, 1, 2, 3, 1, 2, 3. Correct. Then
No, 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 no.
is that's not it.
No, you have written to so the zeros will be five.
Okay, so 1, 2, 3, 4, 5. So this
Yes.
okay, this okay. Okay, good. Good. Okay, so that's 2.1 million. We have shipping, our shipping cost, and that's how much? 10,000 times 10.5. So
105,000.
okay, so we have 105,000.
105,000.
Okay, yeah, 105,000.
Mm.
Okay. Okay, then what else? We have transport. So transport is 20,000. So we put it here. So assembling. Okay, yeah. So assembling is how much? 50,000. So you put it here. What's testing? 5,000. What site preparation? Okay, this is called site preparation. So that's what 15,000. So site preparation. Okay, what else? Uh, duties. Duties is how much? 120,000. Okay, so when you finish, you add everything together. Okay, so that would be the cost of your machine. Okay, so that would be your initial measurements. Okay, that's the initial measurement. Okay, so you record it in your fixed assets register, and when you finish, you also record it in your financial account system. All right. So you record the details in your fixed asset register, the name of the asset, the supplier's name, the asset code, the useful life, the depreciation type, whether straight line or maybe reducing balance. Okay, you put it in your fixed asset register. Yeah. So then you look at the subsequent measurements. All right. Okay, so it appears our time is up, right? So we'll end here. We'll continue tomorrow, God willing. Yeah. So today we've at least we've started on a good note. We have gone through the some of the theories and the financial reporting, and we have started with our first standard. Mhm. So we'll finish. We'll try and see if we can finish it tomorrow. If not, we'll continue and then we continue
I
later.
guess Brazil is out. I'm not finished. Yes.
Hello. Yeah. Okay.
Hello.
Okay. I thought you were talking to us.
Oh no, I was thinking. I was saying something else. Man. Don't
Oh.
worry.
Okay. 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 All right. So on this note, we shall call it a day. Thanks so much for joining. I'm very grateful. God bless all of us and see you tomorrow, God willing.
All right.
Okay.